I'm Keith McCullough, and welcome back to another Real Conversation, where I'm super excited. I've never had an opportunity to have Jim Chanos, who you all know, or you should know, founder of Kynikos, here in the studio for a Real Conversation. There's so many things that I've always wanted to ask Jim, and I know that you have your questions too, so keep popping those in the queue. We can actually rate your questions now, so your questions only get asked if they have a high rating. So that's what that is. But thank you for taking the time.
It's great to be here.
Awesome, man. I was asking you, like I usually do, pre having this conversation, can we talk about your process first? And then you sent me the syllabus at Yale that you now have. For those of you that don't know, Jim now has his own class at Yale, which is super popular, if only because you take everyone to Pepe's and have some beer and pizza for the real stuff. But just wanted to put, to get your frame on that and your lens and why you thought it was important to create the curriculum and what it's all about, essentially.
Right. So the class is now, we're going on about 10 years of teaching the class at Yale SOM, and I teach it every other fall at the University of Wisconsin, which is my family's alma mater. And it's evolved over time, but the idea when I first sat down with Rick Levin at Yale was that the thread of fraud is somewhat consistent in the financial world and business world, and business school students are taught to emulate success, and rightly so. But as we know, you're at most likely at some point in your career, whether you're in finance or in business or in nonprofit, going to be confronted with wrongdoing. And how do you recognize it? What do? You might not short an end run, but it might hurt your career or your portfolio. And so what we've tried to do is set up a systematic set of models, and then take a historical narrative, starting with the first IPOs back in the 1680s, where there was tons of fraud involved, and move through the centuries and see just how fraud manifested itself in the financial markets. How could you have identified it? How could we use models today to look at current situations? And of course, history doesn't repeat, but as someone said, it does rhyme. And it's amazingly consistent how human behavior has been on the dark side, if you will, in some of these things. So the course has morphed into something pretty comprehensive over the 10 years, and it's also a fun class to teach.
Yeah, it's amazingly comprehensive. Your reading list is fantastic. It's something that I'm going to try to share with some people after we're done with this. But it's interesting that you start within the lens of history. I mean, it's if only you're applying your models post that, even if you were to apply like a fractal model, you're looking for similar sets, you're looking for similar patterns. It started as a history class.
Yeah, it started as a history class, and technically. And we do use a historical narrative, but we do, because it's a business school class at both universities, we do apply systematic modeling and try to fit the historical narrative where it fits and where it doesn't fit. But human behavior hasn't changed that much over the 300 and some years, so that's what's interesting.
When you look at today's behaviors, I mean, we can call it fraud, we can call it comparable behavior. Do you think it's more probable that you'd find it in private markets or public markets? Is private easier to find your way around? Obviously with Theranos it wasn't.
Yeah, well, I mean, obviously one of the best things about the U.S. markets is the level of disclosure. And in private markets you don't have that level of disclosure.
Exactly.
You have the world of NDAs and selective disclosure. So we're not active in the private markets, although obviously we see what's going on in the WeWorks of the world and the Theranoses of the world. And I think that one of the reasons that companies are staying private longer is the capital markets have gotten deeper in the private markets. But I also have this nagging feeling that another reason is that some companies just don't want to be put up to the scrutiny of the public markets.
I mean, that's similar to a topic I want to get into, which is the Chinese market. I mean, at the end of the day, I'd say it'd probably be an understatement to suggest that you might think it's rife with fraud or bad behavior.
The People's Republic of Madoff, as Jim Grant calls it. Look, I mean, the Chinese market, we can get into it, is kind of the worst of all worlds in terms of this topic, because you have opacity, you have the VIE structure, where you don't really own the assets in the PRC if you're a Western investor, and so on and so forth. And then for the large companies, you have the dominating aspect of the Chinese Communist Party, which is your partner, whether you like it or not.
Now, just before we go there, let's park that for a second and go back to how you tie it in. You take your course and you also tie it into what's happening in everyday life, like
Right.
monitorable behaviors, things that you can measure and map. Students might see the pattern recognition.
Right.
How interesting is that for
Well,
students?
so at the start of every semester, I usually pick a couple of topics that are somewhat timely and ask the students to stay abreast of developments in those topics. So recent topics would be Tesla, shockingly, Bitcoin, China. And so during the course of a few years ago, we were looking at the roll-ups in the drug industry. And so I want them to sort of real-time keep in mind that this is what the course is about, right? Taking these historical narrative and the models and applying it to what we're seeing today in the financial world.
Yeah, and you have your models, and I don't want to we're not going to dig into all of them, but the 5 different ways. I mean, by the time I got to the end of at least the intro to the class, you've effectively given people 5 different ways to show that public companies, can engage in fraud.
Right. There's a macro model. There's a micro model at the corporate level. We have a governance model, which was popularized by Bill Black. And then we have Bethany McLean's legal fraud concept. And then finally, we finish up with the 7 Signs of Ethical Collapse by Marianne Jennings, which has a very handy checklist of companies, of attributes of companies that have been found to commit fraud. It's a very interesting a little checklist.
And you have a checklist of great questions. I'm not going to ask you all of them, but I wanted to ask at least what I thought were the most appropriate 3. What are the pressures, opportunities, and rationalizations of the fraud triangle?
Right, so that's our micro model. So basically the fraud triangle says what motivates you, what are the pressures, that's the P, what are the opportunities to commit fraud. So usually you have to be in the C-suite, you have to have usually a few people knowing what you're doing and co-opting them. And then unless you're a financial sociopath, and there are a few of those out there, the R is rationalization.
Okay.
So what pressure, opportunity, rationalization. And almost all of our frauds at the corporate level fit into that model in some way, shape, or form.
And that's a good framework. I mean, I think frameworks generally can help people, particularly in short selling, because we've been vilified. You've certainly been vilified. I think I have more years to go with this Hedgeye platform. I get vilified every day with legions of tweeters. Thank you for joining us, by the way. But I often think of this because I'm a macro guy. So I think, how pro-cyclical is fraud?
Yeah.
And that's really a question that do economic cycles actually impact fraud or the pace of fraud?
Right. So on the macro model, which is the Kindleberger-Minsky model, there we look at the macro environment, and what we found down through the historical narrative is that the fraud cycle follows the financial cycle with a lag.
With a lag, really?
With a lag. And often is amplified by bull markets in which disruptive technologies are the main factor. So what you'll see is that, for example, the .com, we saw, interestingly, much more idiosyncratic fraud after that bull market than previous or even the bull market immediately after. And so part of it is that people begin to suspend their sense of disbelief. And as the bull market goes on and more people are sucked in, you begin to believe things that aren't true, and companies and or managements begin to proliferate that are happy to sell you stories that aren't true. And so it's why most frauds are revealed after a market rolls over. Think about Madoff or others, because at their core, a lot of frauds are Ponzi schemes. And when people close up their pocketbooks and demand their money back, most frauds can't deliver. And so, and we've seen this down through the centuries, quite literally, the wrongdoing doesn't get exposed till well after the peak. Same in the .com era, we saw Enron and WorldCom, and at the tail end of that be revealed. So I think that it'll be interesting to see in this bull market if that plays out similarly. But it's been a consistent macro observation over the 300.
Yeah, again, it makes pro-cyclical sense to me because you need a revenue slowdown to reveal, whether you have revenue fraud, expense fraud, balance sheet fraud, you have to have that rate of change slowdown to reveal
You
some
also
of the
have
problems.
easy credit creation.
And easy credit creation, exactly.
Yeah.
So and all that's pro-cyclical. I
Yep.
mean, the banks will take their loan loss provisions after the fact.
Right.
Companies will start to go down, then you'll see the issues.
And
So I guess it makes sense.
And you also tend to be much more suspicious after you've started losing money.
Yeah.
You pull up in the file again. Wait a minute, why are we in this?
Yeah.
And I've often said that stock prices are the very best defense counsels and prosecutors for fraud, because when stock prices are going up, companies are bulletproof.
Uh-huh.
And it's not till they start going down that people begin looking closer, law enforcement, government gets involved, because there's political pressure for them to get involved.
Yeah.
I've lost a lot of money. It's not my fault.
Mm-hmm.
They defrauded me.
Well, I mean, it's the beginning of the end of the bubble is what creates a bubble. It's a story and a chart.
Yep.
And now we have the story, the chart, and the machine,
Right.
which perpetuates the upside of the chart because it becomes a momentum factor.
Yep.
And then when it comes down, I mean, these things have come unglued. They don't even have to be fraud. They just have to be what I'd call rate of change slowdown in a growth story that has unlimited TAM, which I'm sure you love that statement. Or the latest, actually, and this is one I want to ask you about, which is not in your syllabus, which is secular growers. This is a bit of a bee in my bonnet, which is, of course, they're secular if they've never seen a cycle.
Right.
So we're, by my definition, I'd say that we're a super late cycle. So we're about to enter a happy place for long short as a strategy, but also short selling, because it's got to be. I mean, you're already starting to see it, right? I mean, we're starting to see it. We're starting to finally see. You saw it. You nailed Grubhub, for example, recently.
Yeah. There's been some alpha in the last year and a half.
Yeah, and especially in the last 3 months, which is kind of interesting. Most feedback I get, because we have a lot of clients like you that are basically, hey man, I don't care if the stock market's going to go up every day anymore. My shorts are actually starting to work. Yep. So that is also endemic to super late cycle, is that they can't deliver the story any longer in revenue.
Interestingly, if you go back and look at our short-only business, and that's only about 20% of our business, 80% is our hedge fund.
Yep.
But if you just look, and of course the hedge fund is driven by the short side. So if you look at it historically, and again, no guarantees, but our alpha, interestingly, historically, tends to expand before the market peaks. Mm-hmm. So late 90s, 06, 07, 87, 88, 89, before the 90, 91 bear market. And that's been an interesting observation, that some of this stuff starts to falter, some of the more questionable stories, as the indices power higher.
Mm-hmm. Well, because it's also quite typical of super late cycle in a market. It gets narrower in terms of leadership because you start to drop out the companies that can't make it up any longer.
Could be.
Do you have any thoughts on, by the way, on software being a bubble or these TAM stories? Like, do you, at that sector in particular, I haven't seen you talk about that.
We haven't. I mean, because we've actually found, sadly or not, we've found companies being valued like that aren't software as a service.
Even better.
So I found sort of mundane businesses where suddenly they're deemed subscription businesses and they trade at 10 times revenue. So the obviously software as a service can be an amazingly profitable thing if you truly scale. It is and yet. When you look at companies like food delivery, Grubhub, it's the furthest thing from this, but yet people lump it in on the up phase as some sort of magic TAM, subscription story, digital story, disruption story, and in fact, it's just a body shop. And so that's where we've been trying to focus on companies that are being valued like these premier operating businesses, but are in fact something quite different. I'll give you a great example. Zillow. All right, Zillow and Redfin have over the last 10 years moved a lot of retail real estate brokerage digitally, and successfully. But that business is slowing. In Zillow's most recent quarter, their sort of core, what you would consider their core digital premier brokerage business, I think was only up lower mid-single digits year over year. So what is Zillow doing to sort of keep the growth story exciting, because it trades at a huge multiple of revenues? House flipping, which is the ultimate non-scalable business, right? It's just they're buying houses for their own account and flipping them at a loss.
Wonderful.
And making it up on volume. And so, and yet the revenue growth now still looks great, but it's a completely different business.
Yeah, way lower margins. Yeah. It's an amazing thing. I mean, on that, stylistically, I get a lot of feedback. People think short selling is done by bad people, or it's done by only people who look for expensive stocks.
Right.
I mean, if I look at most of your work, and particularly your biggest successes, it's been based to me on just one word: believability. You're just not willing to believe what management was saying relative to the numbers that you're looking at.
Hopefully, but with evidence.
Yep.
Right. And so I think that's where we try to at least make a difference. Something can look great, but if the business model is fraught with risk in things we see, or that are not sustainable, or are based on rent seeking, and we can talk a little bit about one of the idea I think that you guys and I are on the same side on that one, then we're interested. What I mentioned, the drug companies, the roll-ups like Valiant earlier, and there it was, the whole concept was we're going to buy drugs and raise prices because R&D is wasteful. It's much better to pay up for drugs are successful, which is great. The part they didn't tell you is the sellers weren't stupid, and they were selling drugs that had very short lives. They were coming off patent. And so the concept theoretically sounded good until you got to the execution. The market was far more efficient than the bulls were led to believe. And so at the end of the day, most of our shorts are business model shorts, or there's something wrong with the business model. True fraud is very rare.
Does it surprise you that so many, and again, our business, as you know, is loaded with people who went to the same school you and I went to. It's not an intelligence problem. It's a gullibility problem.
I think that look, humans want to believe, and we've had an amazing economy and amazing financial markets in the U.S. We've been blessed. And so it's paid to be an optimist. But the reality is on the micro, and this is why we're sort of long the market and short our companies, is that on the micro basis, lots of things fail. And that's good, that's capitalism. But even further on the scale there, lots of things fail for reasons that should be obvious to people but aren't.
Yeah, I mean,
and that's kind of the area we operate in.
Yeah, because and when you mentioned Valiant, I don't think anybody would ever accuse Ackman of being a non-intelligent person. No. But that's being wrong on an epic order.
Well, it's fascinating to me, and it wasn't just Bill. The Valiant was the largest single hedge fund loss in history in one stock.
A lot of people follow Bill too. I mean, he was the one pushing it.
Again, I'm not looking at anyone individually, because there were lots of people that owned this thing that knew better, because we and others concurrently were pointing out to them that the company was adding back, and this gets back to pro forma earnings, which we talked about before the telecast, are adding back things that were actually real economic expenses. And in the case of Valiant, it was the amortization of the purchased R&D. They were simply paying it up front by buying drugs as opposed to developing them. But then they told you that related amortization was really not an expense. The fact of the matter was, it was not only an expense, it was understated, because they were writing it off over 10 to 11 years, and the drugs had a life of about 6 or 7. And so the CEO of Valiant was a very persuasive guy who convinced the street for a couple of years that 2 + 2 equaled 5. And Wall Street has a long history of believing 2 + 2 is 5. If they think they can make money off it.
Do you think that it is ironic that the most popular class, or at least one of them, at Yale School of Management is your class, and we still have what I'd call that business school mentality or gullibility of the real world?
I think it's because I buy them beer and pizza after class.
That's got to be it. But you will often see, and the hardest thing for me to do, particularly with our young analysts, is to teach them not to believe what's in the management slide deck.
Yeah.
Not to believe the bullshit. It's a hard thing to do.
So we have a concept both at the firm and at my class. And what I tell my students and my young analysts is, I want you to look at a company as if it was layers of an onion. And if we think about the core of the onion as SEC mandated disclosure or government documents, anything that you and I would consider a source document. The next layer would be company press releases. The next layer would be management conference calls to answer questions about the press releases. The next layer would be sell-side research. And then finally, the last layer is social media, rumors, trade desk chatter. Most investors invest from the outside going in.
I love that analogy.
And they never get to the core. And what I try to teach is start with the core, start with the source documents and work your way out. And it's amazing how the story changes if you go two different ways. In looking at a company, what they're forced to tell you, what the lawyers make them tell you or are worried about, to make them tell you, as opposed to then the first layer of spin, the second layer of spin, the Wall Street spin, and then social media or rumors mill. And sometimes it's like you're analyzing two different companies.
It's amazing. It truly is. I mean, we just had not to pick on software, but one of my analysts started pitching like they always do, a new idea. And where he starts is what mattered. And he said, well, in the S1, Keith, it's a 20-year-old company and they only showed 2 years of revenues, i.e. post-tax reform when revenues went up and to the right. And it's a long-time IT services company with a storytelling CEO. I'm like, okay, now I'm listening. Because we start with, we start with the financial documents.
Start with the documents and start with the risk factors, particularly if you can go back to an IPO and read it.
Yeah.
And because they will tell you things that they're not going to tell you on the conference calls or in answers, management answers to questions or sell-side research, by and large.
Yeah, what percentage of you have actually read that own Tesla have read the Ks and the Qs, at a very basic level? Let's just be honest with that. But on this, I mean, this onion, like when you think about it versus prior cycles, that outer layer of the onion, that media component, and particularly the old wall media component and the social component, has to be as loud as it's ever been.
Well, what's interesting, Keith, is as a graybeard, we're starting our 35th year at Kynikos, and I was doing it for 4 or 5 years before. The difficulty back then was getting the information. If you got the 10Q a day before everybody else, you had an edge, right? And so I was taught to hustle to get source documents, all that good stuff. But the problem was finding information. The problem today is exactly the opposite. It comes at you in a fire hose. And the real issue is understanding how much that information is really signal and how much is noise. Mm-hmm. And again, I can tell you that the most signal of your time per hour of your time will be source documents. Everything else you can fill in later. But because of this stuff just comes at us, through a fire hose, we lose sight of that a lot.
Yeah, source documents, primary field research. This is essentially, I mean, your revelations on China, by the way, were early and right. I mean, that had to, how frustrating was that relative to the received wisdom from the outer layer?
Well, it's funny because we get chided a lot, even today, about, well, you said China would be in smoking ruins by now, it's still going strong. And meanwhile, China's been probably the best short you could have had for the last 10 years, because every other market has doubled and tripled, and China's been flat to down.
Yeah.
The FXI, when we started looking at China, was, I think, 41, and I think it closed last night at 41. And that was late '09, so it was 10 years ago. But what really intrigued us about China was what we had seen in previous real estate bubbles. So one of our big calls in the late '80s at Kynikos was the commercial real estate bubble in the US.
All right.
And the tax laws had changed. People hadn't figured out that the tax law had just put a torpedo into the ocean liner. And we're still building and still doing tax shelter deals, and then everything collapsed. And then we looked at things like Japan in 1989. We looked at Ireland and Spain in 2007. And what stunned us was the size of the residential real estate market. And to this day, it still stuns us in China. It is the biggest real estate bubble in history, and still is 10 years into it. They're still building 1.8 billion square meters a year of residential, which is 20 million apartments, because the average Chinese apartment is 90 square meters. And we've long gone past, well, build it and they will come, and the rural people will move into, because these apartments aren't affordable for people who are moving from rural to urban. They are only being built at this point for speculation. And it is about, depending on how you want to figure out the ancillary real estate stuff, it's anywhere from 20 to 25% of their GDP. Investment is still 45%, 46% of China's GDP. And resi real estate is about half of that. And it's stunning. I mean, I always joke, the world's most important single asset class is Chinese flat prices.
I mean, it's guys. If you can show slide 31 in the current macro deck, where I arguably anchor on this because I think it's what drove. You know, first of all, CAT wouldn't be back to where it's gone to if this didn't happen. But you know, the Chinese stimulus.
Well, this just didn't stay up. I mean, that's the amazing.
It's amazing.
Thing. Yeah, they're still building them.
But this line is basically secondary industries. I'm showing on this slide, secondary industries in China, which would include everything that you basically just said, which is heavy construction, partly empty cities, empty apartments. The most cement ever used in human history. I mean, so if you just look at the rate of change of that line, what's interesting about that line to me, Jim, is that even if they're making up the numbers, the rate of change of that line continues to slow and slow, despite easing base effects, which means that you should be showing some even cyclical acceleration here.
Right.
And the October numbers in China, fully loaded, even with shadow financing loans that they're reporting, are horrible. They can't. If you're making up the numbers, make up less bad numbers.
So we've looked, the proxy for that is we try to get a check because again, the Chinese numbers, I always say it's bad apples to bad apples. So we try to look at rate of change. But one of our checks there is also we monitor all the publicly traded banks in China and look at both asset growth and loan growth. Loan growth because it's loan growth, right? And then asset growth because all kinds of other shadow banking stuff usually in China ends up on banking balance sheets in one way, shape, form, or another. Receivables from other banks, investment products. And so we try to look at that growth year over year. And it was slowing. It's interesting. It got down in spring of a year ago, first quarter of 18. The year over year growth came all the way down to about nominal GDP in terms of the aggregates of all the banks. Got down to about 8-9%, 7-8-9% year over year, which was sort of nominal GDP, and these are nominal dollars. And that's when the deleveraging, they stopped the deleveraging talk. I think they were beginning to worry that stall speed was going to hit. And this has happened a couple times now in the 10 years we've been following China. It happened in 2010, 11, and then 14, 15, and then more recently. And now it's running back up. The aggregates, I think, are running back up around 10, 11, 12% year over year, which is sort of twice nominal GDP. I like to joke, when I started looking at China, Hainan, which is the little tropical resort island in the South China Sea, had one international airport. Shortly after we started following China, they announced and have built a second international airport, and they're about to announce a third international airport. The first one was essential, the second one is luxury, the third one I think is folly.
Yeah, well, you just keep building it, building it and building it.
Well, it's the problem with any investment-driven economic model. I've often said, look, if half of your GDP is investment, you know what your GDP is going to be that year on January 1 because you're going to set plans and you're going to, every time a building is finished, you're going to put up another one. But are you really building wealth in your country if you're doing it with credit, you're doing it on the back of your people who are saving the same, you remember back from your macro class, S equals I. And so they've got to save that much. And is your banking system really what you say it is, because no one ever writes off a loan. And that's the real problem here. The debt's there, the assets don't earn a lot of money, and in fact depreciate because they're so real estate centric.
Well, no, like you've said many times, I mean, no bubble or fraud is the same, but the patterns of behavior repeat. Do you think, last question on China, do you think that there are similarities to the early 90s and really today for Japan versus now China? When I see the beginning of the slowdown from the secular peak, and I see everyone trying to defend it and now looking for a trade resolution, they're so short term about it. But if this is this the 1990s in Japan?
So I give a talk a few times a year to Chinese bankers, usually up at Yale. And it's funny, they asked to hear the lecture. I don't know why. They must be masochists, but they're all no, and they're lovely people. And they've invited me back to People's Republic. But as my mother said, never go to a fight you're invited to. So I've avoided that. But consistently lovely people. And I put up at the end of the lecture, and it's usually translated, at the end of the lecture, I put up who am I? And I put up a state-driven economic model, heavily reliant on investment and real estate, protected currency, exporting capital to developing market countries as a way of diplomacy, a managed exchange rate, capital controls, blah, 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 blah. And the Chinese bankers always laugh, I'm talking about China, and then I put up the last slide, which is the rising sun. I'm Japan of 1989.
Oh, wow.
And there are quite a bit of similarities other than democratically elected government. A lot of the similarities are there if you look at it, because even Japan back then had this state-directed kind of quasi-capitalist model where you had mini and MIDI and these big government agencies directing the large conglomerates. And you had a fiercely protected currency, you had a real estate bubble. The parallels are interesting.
Yeah, very interesting.
Yeah.
And it's also like, so what tips it? And the same thing applies. I think, when do you see the most amount of frauds? When it first starts to slow from a cycle peak. I mean, when Japan first started to slow, what happened? USA got in a tariff war with Japan.
Yeah.
It's an amazing thing if you look at the two side by side.
I forgot about that.
Yeah. On to one guy likes to do business in China. Maybe he's going to just move his auto operations there. He's already done part of that. I'll just give you an opening volley on Tesla. Like, what's up with that?
Well, the stock is.
Yeah, it is. Right back to where it always goes.
Yeah. And I will say that Tesla is and remains one of our biggest and our best short positions.
Awesome.
I think there was some speculation on social media about that yesterday. So for anybody watching, we're still bears. Look, this stock has been in a trading range for about 5 years now.
Yeah.
And it's funny. I always try to tell people that at below 200, everybody thinks the company is about imminently to go bankrupt, including Elon. Let's point out that he earlier in 2019 he talked about the company being in financial trouble, and then very famously in the spring of 18 he said they were weeks away from insolvency. So we're not making that up, right? But I try to just point out to people that the company has had enough liquidity, even when the stock price was nosediving, that they probably weren't imminently going bankrupt, as a lot of bears on social media were prematurely spiking the ball. On the other hand, at $350, $360, and being taken out at $420, this company is an auto OEM, and it is trading at 6 to 7 times where all the other auto OEMs. I posted something just a little while ago, just showing just how much Tesla looks like the other auto OEMs.
Amazing.
In terms of margins, and except for valuation. And the rest of the auto OEMs globally trade in an amazingly tight band of 0.5 times total enterprise value to revenues. And it's been like that forever. It's why auto stocks really don't perform a lot, because it's a capital-intensive industry, and you get a valuation of 50 cents on the dollar of every dollar capital you raise, right? It's a problem.
Yeah.
And also uniquely, both on a mean and median basis, global auto OEMs trade at a little bit under 5 times enterprise value to EBITDA. If you use both of those metrics, either or, with Tesla's numbers, they have about 25 billion in revenues. They have about $15 billion in net debt, negative working capital, long-term liabilities, and preferred minority interest. They have, on a best basis, the best quarter times 4, EBITDA of $3 billion, give or take. It's less than that on the latest 12-month basis. All of those metrics, you run them through the global valuation model for an auto company, and you get a stock price that is, interestingly, worthless. It's zero. And so what you have with the stock at 350, 360, is simply the market's view on all of the future brilliant products that are going to come out of here at amazing margins because they're just not doing it. I think trailing 12 months operating income, including sale of tax credits, is under $200 million at Tesla.
It's terrible.
The company has raised equity and net debt $20 billion in its life. So it has taken $20 billion from investors to get you here. And there's no return on the business. Now, will there be a million robo-taxis next year? Well, there better be, right? I mean, we can talk about all these future products because on just the core business of making automobiles, this company is not worth anywhere close to the total enterprise value of 70 plus billion, whatever it is, and should be trading, of course, much, much lower. And so the problem, I think, with Tesla is that Tesla was correctly early in this. They made an amazing car with the Model S. I've always said that. The problem is the rest of the world was slow, but is catching up.
Has caught up.
And you now got Porsche with the Taycan, which is an amazing car, right? And increasingly now you're going to have very good manufacturers in that mid-price sector, which are going to be, right at the Model 3. One of the most interesting things that I think people ignored on the third quarter conference call, well, two interesting things that I want to highlight that are important for the future valuation of the company, is that the company acknowledged that their Model 3 demand in North America is plateauing at 45,000 units a quarter. That's really important because you run that through the model of how many cars they sell globally of S, X, and 3, US versus the rest of the globe, you can start to get your arms around what the product profile looks like at best case. Number two, interestingly, they said that gross margins for the cars they're going to manufacture / assemble in Shanghai are going to be no better than they are in Fremont. So why the hell are you doing it? Why, what's the point, really? Given the massive capacity and production capability is in China. So there's a lot of head scratchers here, but I think the reality about Tesla is that it's about the stock, not the profitability of the company. And this CEO, as we know, is very promotional. And sometimes it works for him, and sometimes it works against him. And that's what we've seen for the past sort of 4 or 5 years.
Yeah, promotional would be probably the kindest word I thought that could come out of your mouth in describing him. And that's very, that's gentlemanly of you.
I want to also just point out, everybody sort of talks about Elon and the Bears, and everybody conveniently forgets that the Bears are already 1-0 here, right? Because a lot of us were short Solar City, which was going to 0. He took it off our hands at 20. Most of the shorts were short at multiples of 20. And he used Tesla shareholder money. Now, admittedly, conflicted Tesla shareholders voted 80-some% for the deal. So, God bless. But that stock was headed to 0, and if you read the depositions in the Solar City lawsuit, you will see very clearly that the companies thought this thing was going to hit the wall. The bonds were yielding over 20% when they announced the deal. And so, this is, I will say that the Bears can already say, they've already won one against Mr. Musk. So we're in round 2 now.
And round 2 is going to include round 1, to be clear. It's not like this has gone away. Could there be a not so funny irony to him that that's actually what grabs him and takes him back under the rug from a
there's a lot of debt that came on because of Solar City connected to the solar panel leases. And the problem with the solar leasing model, and there's still some companies that trade publicly that still do this, is that you own the panels, right? It's an asset on your books, and the residents pay you a monthly lease payment, but you've got to maintain them, and and in many cases, one of the things we like to look for in companies is where the assets are actually liabilities, and in some of the cases of solar panel leases, I think that might be the case. And so, there was a lot of net debt taken on in the Solar City deal that I don't think is economic.
I mean, there's a lot of things that aren't economic when it comes to him. What do you think about the chiding of you and David Einhorn? Like, we're talking about you guys will get things right, you'll get things wrong, so does everybody else in this business. But talk about picking a punching partner. I mean, he's picking 2 of the sharpest minds that are left when it comes to actually starting with, like you said, starting with layer one of the onion.
Yeah.
Do you think that there's an irony in that?
Heard worse from better.
Right.
But I'm just saying that that it comes with the territory. If you're a bear, a short seller, and you're public on something, you're gonna get lots of arrows. I mean, I'm a big boy, and so I've been around this track a few times, no pun intended, and I got the scars to show it. And yeah, we're not right all the time. We know that. That's why we have a portfolio. But one of the things that we do, and I know David does from time to time, is we show our work. And we'll tell you if we are going to go public on an idea, and it's usually a small minority of our positions.
Yeah.
But we'll let you know why, and we certainly let our clients know why, what our thought process is, why we think that 2 + 2 is not 5, how it fits into valuation parameters, what are the risks, and look, if we're right, we're right. If we're not, we're not. But it's hopefully not for lack of work.
No, the work part's interesting. I'm surprised I've not been. I'm a nobody. I guess that's why. But I mean, we publish all of our work, and it's been accurate. I mean, in terms of
I've seen it.
Tesla demand tracking, Tesla used car pricing. I mean, all these things have happened.
Yep.
They're truths. You know, and so is the
Insurance-
fact that
insurance costs.
I mean, it's not no irony either that we started with this short as a bad manufacturer.
Yep.
We didn't start with like a bad vision or a bad tent.
What's
or a
fascinating, one of the things we've noticed to that, and right to that argument about this story, is that people who were actual automotive analysts were the ones on the sell side.
Yeah.
Were the ones who were the most skeptical.
Yeah.
Right, because they toured the plant and they detailed and they saw some of the stuff that the CEO was saying was just craziness, nonsense. And it was the solar analysts or the tech analysts or whatever who are still to this day consuming large amounts of the Kool-Aid. And I think that's an interesting dichotomy. And yet this is, and the thing I posted on social media a little while ago, this is very clearly a car company, an auto OEM. It looks like an auto OEM, it talks like an auto OEM, and it walks like an auto OEM.
What do your students say when you use this as a case study? So when I asked them to keep an eye on Tesla for Keep an eye
for my fraud class, it's funny because I'll say, well, this semester why don't we monitor news at Tesla? Maybe a year ago I did Bitcoin. China's an evergreen kind of story, and I always, among MBA students, I always get this quizzical look when I say Tesla. Why would we be monitoring that? And then I get a quite different set of responses at the end of class from my students who have gone through the fraud models and whatever, and they're asking me quite different questions. They're like, why is this allowed to go on?
Yeah, why is this guy in jail? Why is
I'll let you say that.
Yeah, I mean, I didn't hear that. I I didn't say it. I heard. You never know what you're going to hear.
You never know what you're going to get asked.
Please fire your questions in the queue. I'm going to take those momentarily. I want to ask Jim about one other idea that's familiar to us, and that's just going through DaVita.
Oh,
so
yeah.
It's a different, it's totally different industry, obviously.
And a different story, but interestingly, so we talked a little bit about the drug companies. And DaVita, I gave this idea at Seeking Alpha, and of course, as always with Seeking Alpha, I'm down in a media 20-some% on it, which always happens. What's happened with Continental Resources and a number of stories, Caterpillar. Anyway, the story here is interesting in that there's basically a duopoly of kidney dialysis in this country. But if you look and analyze the business of DaVita, which is a roll-up of kidney dialysis centers now that's kind of stopped, they make all their money from commercial insurers. Medicare, Medicaid pays $50,000 to $60,000 a year for patients to do this, and most end-stage renal disease patients, sadly, are either older or poor, and qualify for Medicare and Medicaid. The reason that they make all their money in commercial is they charge commercial insurers 3 to 4 times. And that's not supposition. That DaVita has actually put out materials in their investor decks that point this out.
They're proud of it.
And well, they certainly didn't hide it.
Yeah.
There was a recent Blue Cross Blue Shield lawsuit in Florida that walks you through how this all works. And the way it works, and you can also glean it from reading the risk factors in their 10K, is if you come in and you're a Medicare patient, they will try to steer you into a commercial policy. And the commercial policy might cost you $10,000 a year as a senior, as opposed to Medicare, which you're already getting. Well, why would you do that? Well, the service will be better. Our premium locations might be more convenient. Blah 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 blah. They'll then tell you that the American Kidney Fund has a charitable assistance program that will pay much, if not all, of your premium.
Lovely.
Lovely. And of course, they will then say that if you go talk to them, see what will happen. They will then charge that insurer, if you sign up through an Obamacare exchange, for example, for $10,000, they'll charge that insurer $180,000 as opposed to 50 or 60. You want to know who the two biggest donors to the American Kidney Fund are? DaVita and Fresenius, the two big players.
Not by a little. I mean, I think our numbers said 130 million they gave them.
They gave them, I think the ACAF got 270 million in a recent year from both of them. So
combined, so yeah, a big part of it.
Well, think about if they're if they're giving that, and that's going to the insurance premium, and then they're getting 20x on that back. That's a couple $2 billion. Which, by the way, the EBITDA here is about $2.2 billion.
By the way.
Well, they've said that all their profitability comes from this.
Right.
So why is this? Why is this bad? Well, number one, I think it's insurance fraud. Number one, and this is why I was sort of stunned to see Berkshire Hathaway as the biggest shareholder in this.
Also, not by a little.
Not by, I think, 28% or something like that. And it just shocks me that they would condone this by ownership, being in the insurance business. Number two, their safe harbor, and this is the important part. The safe harbor they have from federal rules against this, self-referral and so on and so forth, is that they cannot direct the charitable giving by the American Kidney Fund itself. In fact, they can give money, but then it's up to the American Kidney Fund to decide how they disperse charitable aid. The problem with that, and the reason we got really negative on this summer, was that there was an unsealed whistleblower suit from 2016. It was unsealed this summer, in which the whistleblower was a former American Kidney Fund employee who worked in the charitable giving section. Said that, in fact, Fresenius and DaVita were directing the aid. That is a huge deal. That is a smoking gun, if true, because it now means that they may be running afoul of the safe harbor. And my view on this is the company has been buying back stock aggressively. They're leveraging up the balance sheet, as I think they want to pay out the value before it's gone, so to speak. The stock's back at 14, 15 times earnings, and what I would believe if I was an investor is I would not be putting a lot of multiple on this rent-seeking part of their business. It's going to go away, just like Acthar at Mallinckrodt, just like surprise billing at the emergency room guys like Envision Health. I mean, slowly but surely, the government is getting to these rent-seeking anomalies because of Obamacare and structure. And I would think that this isn't going to be around in probably 5 or 6 years. Would be my bet. And then you have a company that's inherently unprofitable that is now getting levered. I think that leverage is now pushing close to, with the latest buybacks, we're going to have debt is going to be close to 5 or 6 times EBITDA. So this is becoming a really, really levered play on this. And it's going to increase the risk value, but it's still going on, to be fair. I do think, however, that slowly but surely people are wising up. California just passed a law preventing charitable assistance for dialysis.
Yeah, so.
And so if we see a trend either at the state level or the feds moving in because of the lack of this safe harbor anymore, DaVita's got a big problem.
A big problem, a real big problem if Buffett decides that that's not what he should be.
Well, and now it's as I say, now it's levered. So now you can see a path where the stock could go down a lot.
Yeah, those are your vintage Jim Chanos shorts. You have questions here that have this one, and by the way, your questions are being rated. So of course, this is going to be the first question.
If there are any from someone named Chanos, don't take them.
It says, Mr. Chanos, if Elon Musk was in the studio with you right now, what would you say to him?
I would ask him a lot of the questions I think that my good friend David Einhorn asked him. We were puzzled both in the third quarter of last year and the third quarter of this year of what looked to be supplier changes and arrangements. In fact, in the 10Q of this year's third quarter, they actually now put a table in for the first time and made reference of language of agreements entered into at the end of the quarter. So clearly the lawyers at Tesla are worried about something that happened at the end of the third quarter where they put this into the notes. And I'd like to quantify how much did that impact the gross margins. That would be one thing. The second thing I would like to talk to him about is why are all your executives leaving? I mean, it is kind of stunning to us that this company just can't keep senior executives. And why is it they get there and leave, and they leave lavish stock option packages on the table? And really, what possibly could they be seeing that you're not disclosing? You know, whether it's CFOs, chief accounting officers.
I guess that's a talk about similar sets and patterns of behavior. That's not dissimilar from shorts you've made a lot of money on. Yeah, that kind of behavior.
Well, when we see, I mean, so a dead giveaway. I mean, when you see stock sales, and by the way, senior executives and board members are selling lots of stock through 10b5 plans at Tesla. But when you see that coupled with executive departures, that's almost always a red flag. And so I want to know. And then I'd really want to ask him about these constant pronouncements of full self-driving, a million robo-taxis, you know, things that cross-country trips by full self-driving cars. You know, the semi that was supposed to be out this year, it was announced 2 years ago. I mean, why? What is to be gained by this if you just keep missing these great pronouncements?
Well, you can pronounce anything, and as long as people in the moment are willing to believe it, you just got to hope they forgot that you said it. This one's from Joe. I'd love to hear in your career what's most similar to Tesla in terms of how it panned out. I think this is an interesting question. Is there similar setup where you get the story right, then it goes wrong, then it goes really right again? You know, like what is? It's an important question.
Yeah, it's a good question. I think this one is kind of unique because it's been such a bull-bear battleground for really 4 or 5 years now, right? And it's under a lot of scrutiny, so it's become kind of a bellwether for I think for sentiment in the stock market, among other things, whether from retail investors or hedge fund investors. And we see it with the short interest numbers that go up and down too. So I think this one's kind of unique in that I've seen a lot of battleground stocks where, you know, one side or another has kind of figured out after 5 years, you know, this isn't working, and this one isn't, because it's going up and down, and it's become sort of these monster moves, and yet you know, it's underperforming the market. Yeah. So that's what the bears are also pointing out. You know, guys, this stock hasn't gone anywhere, and I think Nasdaq's up about 80-90% during that period.
Yeah, that's
almost it's an interesting prism through which you can sort of see people's views on the market and views on lots of things. Is how they view Tesla.
It's the point that you made on happy accounting though too. I mean, like, isn't this a greater pattern that repeated back in 2000, 2001, when the biggest part of corporate credit was technology and telecom? Yeah. Today, that's the same thing. We have adjusted EBITDA as far as the eye could see. We have people willing to believe that triple Bs are going to trade like sovereign debt for as long as cash flows can never go negative. Yeah,
the one. So I gave a talk at CFRA last night about hiding in plain sight, pro forma accounting in the post-truth age.
And love that title.
And you know, people sort of ask us a lot, well, where are you seeing the excesses? You know, I get that a lot. And one of the areas is just the broad observation that a lot of this stuff is hiding in plain sight, Keith, in that it's pro forma accounting where the companies are just presenting the metrics increasingly in more outlandish ways to burnish their results. And so the biggest of which is probably the increasing amount of share-based compensation that now gets added back to pro forma earnings. And any way you cut it, that's an expense. And so a lot of these companies now are, and by the way, Tesla's $200 million a quarter of that. The dollar plus a quarter is share-based comp added back to their pro forma EPS. And so investors, getting back to that onion that we talked about, where if you looked at Valeant Pharmaceuticals in its heyday, in 2015, its pro forma cash EPS, which was the press release number, and the number the algos traded at, and the hedge funds pointed to, was $11 to $11.50 in 2015.
And what the debt traded on?
Well, no, they actually lost GAAP. They were losing money.
Man.
So think about that, and the stock got to 260. So that's what you'd call cognitive dissonance on a large scale. We're seeing this more and more. Take a look at a company like Salesforce.com. We're not short it.
I want to short that.
I think 70 to 75% of their pro forma $2.50 in earnings is share-based comp.
Wow.
Lyft, which recently got a rally going because it pulled forward its profitability forecast. We're going to be profitable at the end of 2021, not 2022. If you read the fine print, it said before share-based comp. And so for share-based comp, that's a lever management can pull at will. They can just pay people more in stock and add that expense back.
And now they say it, and the stock price, Lyft's case, actually went up.
Yeah.
So now you can sell your share-based comp whenever you get it at the end of the year at a higher price.
It's an amazing perpetual motion machine.
Wow.
Until it isn't.
I don't know if you've done work on this one, and just pass if you haven't, obviously, but Jim, can you please talk about Netflix content accounting? Have you looked at it in the underlying economics of how that's calculated?
So we look at Netflix as I know you guys do. Just a couple of observations about Netflix. Netflix had an amazing proposition for people, because when they became this new outlet for content, rather than video stores or cable deals, the movie studios and the cable networks basically said, "Oh, Netflix is going to pay us $50 million a year for our library. That's just extra money."
Yeah, and
they built their model on the back of the Starz deal, where they just bought all this amazing content for Starz for next to nothing, or leased it. And that was a really, really great idea to build this behemoth on. The problem is that they are now becoming what they were disrupting 10 years ago. Meaning that now increasingly they're a digital TV studio, movie studio. And so they're financing content. I'm loath to say owned, because a lot of it is just simply they actually have first rights to it because they finance it. They own actually a very small amount of what people think is the owned content. They have just basically a preference on it. My friend Michael Pachter keeps pointing that out. But now they're in the business of creating hit shows. Now they're in the business of greenlighting movies for $180 million. And they're in the business of hits and misses. And that's a different business. Those multiples in that business are a fraction of the digital disruption model that they used to be. There's one other problem that Netflix has that I think is underappreciated, and that is in their push to go global, which has got people excited. That's where the growth is. They run into must-carry rules. And I was talking to one of your analysts about this earlier, and that is if you're in Norway, you have to have so much Norwegian content. If you're in Turkey, so much of the content on the streaming has to be Turkish. And what that means is that your margins in these markets with must-carry rules are much, much lower, because you can't just leverage your existing library. You have to buy in a bunch of new stuff to not avoid breaking the law. And I think that if you analyze that and you allocate overhead correctly, I think that people who think that the international business someday will have the same contribution margins as the U.S. are smoking something. It won't. It'll be much lower margin. So then you get into amortization, you get into real costs, the arms race on content costs, and you start looking at marginal returns on capital. And this business is changing kind of dramatically from what it was 5 and 10 years ago. And the question will be, can they raise prices? And that's where I think the new competition is going to make it tougher. Prior to that, I would have said, yes, they can raise prices, but they have to because content costs are going up. So it's not because they want to, they have to. Now I think there's a higher probability they could get into a situation where they can't raise prices, and at least for the near term, content costs.
Yeah, when your competition is Disney and Amazon, I mean, good luck with that.
Well, and Disney in particular, because they make content, and it's their business, and then they have the existing library. So, yeah, it's now a dogfight. I mean, they had this to themselves, and God bless, they built this business, right? They built the idea of streaming, but now it's a dogfight.
I love when I ask like a guy that I'd consider the man, like on the short side, like how to think about something. A question about a company that I've never heard you talk about, but clearly you've thought about that one. Maybe last question, because selfishly this is the question I ask myself all the time, and now there's a way to short it. Is private equity a short?
Well, sorry. So what I've
a
told,
pro-cyclical short at this stage of the cycle.
There's a wonderful guy. There's a wonderful guy on Twitter, Dan Rasmussen, I think at Verdad Capital, who gave a great talk at Jim Grant's conference a few weeks back, and has put some stuff out there, and has done far more work on private equity than I ever could do. I sit on, though, a number of investment committees, and so I see the pitches, I hear the pitches, and I see the results. And I will tell you what's really interesting, and Dan's gone into this, what's really interesting is that the returns in private equity are not what they should be. I'll be diplomatic, meaning they've been at or below public market returns now for a while, if you look at the industry, and everybody can cherry pick to the top quartile or whatever.
Yeah, of course.
But in aggregate, private equity returns are kind of right around, after fees, right around the S&P and the Russell. And Dan's work on this is fantastic, by the way. And so you begin to wonder if this isn't like hedge funds who really saw their glory days after the dot-com era because they were short the junk and long value, and that worked, and that made your 10-year record through 05, 06, 07 look fantastic. And then everybody went over the cliff together in 08, 09, and hedge funds have had a hard time since. I just wonder, with the massive increase in valuations of equities, the massive decrease in rates, and the availability of capital, why is private equity, given it's a portfolio of leveraged corporations, why is it not making 2x the market for the risks you're taking right now, and the illiquidity and the fees? I just think that if you're just making sort of stock market returns at this point, private equity, you got to begin to ask yourself, well, if that's the case, I've roasted these poor long short guys for poor performance, correctly so, for creating no alpha, charging me huge fees, and then losing money when the market goes down anyway, right? But why am I paying 2 and 20 to the private equity world if I'm long 3x my equity in corporate assets? Something's wrong there. I should be making multiples of the market. I'm not. And I think that is the question I have for private equity, not do they improve the quality of the companies, are they laying off too many? I'll leave that to other people. But as an investor, I would look at it and say, am I getting the returns I am getting commensurate to the risk I'm taking? And the fact of the matter is a lot of pension funds, whatever, love it because the returns have been steady. Because a lot of funds can mark their own positions over short periods of time. And then check a box. Oh, I can just count on the 10, 11, 12% on this one? Fine, done.
Good.
We'll allocate. And I don't know that they're thinking a whole lot behind that. Like, wait a minute. If I'm leveraging up, and these companies are taking on bonds and bank debt to buy corporate assets, what if there's a long period of rates going up and equity prices going down? I don't think I'm going to get that equity rate of return.
It's like I'm obviously not negative on private equity, forever. But at this stage of the cycle, I mean, why would you want to be long leverage, cash flow degradation, and illiquidity? You have a choice.
And as we talked about, as you mentioned, referenced earlier, adjusted EBITDA.
Adjusted. Yeah. Well, thank you for adjusting people's headset on this. I think for a long time, I mean, everyone eventually in this business is going to be vilified, from private equity to bankers to you and I, and I think that, like, just giving you a chance to talk without commercials is like was a really good thing for a lot of people. So thanks for
Let's do it again.
readjusting how they probably thought about what you do.
That's great. Thank you.
Awesome. Thank you very much for your time.
Great.
All right. He's Jim Chanos. I'm Keith McCullough, and you can actually find him too on Twitter. Thanks.